Hi there. Central banks are all-powerful institutions that in most major countries operate independently of the government or political authority. The economic policy objectives of governments are typically the attainment of high and sustained economic growth, full employment, as defined by whatever measure has been chosen, a stable price level, and a healthy balance of payments. Some of these objectives are directly handled by the government based on the political objectives and philosophy of the administration of the day, while others are outsourced to the central bank. As indicated in the opening statement, in many countries the central bank is independent. This means that the governor or governors are not changed each time there's a change in administration, nor do their policy objectives change. In other words, the work of the central bank endures whatever happens on the political front. Most central banks have two main roles. One, the conduct of monetary policy. Two, maintaining a stable financial system. Apropos of nothing, today I will be focusing on central banks' mandates and their conduct of monetary policy. But before I continue, do visit our website where I curate news and publications from international financial organizations and central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. Typically, a central bank has a mandate through which it conducts monetary policy. Most, if not all, central banks have a mandate to control inflation. Some central banks, most notably the Federal Reserve of the United States, however, have what is known as a dual mandate. On the one hand, control of inflation, and on the other hand, maintenance or attainment of full employment. In fact, the mandate of the Fed, as the US Central Bank is colloquially known, is stated in the reverse: maintenance of maximum employment and price stability. Another way of talking about inflation. It is very instructive to dwell just a bit longer on the dual mandate of the Fed. The Fed's Federal Open Market Committee, FOMC, in a paper titled Statement on Longer Run Goals and Monetary Policy Strategy, FOMC 2019, first adopted in January 2012, clarifies the Federal Reserve's monetary policy goals and strategy. The Federal Reserve's statutory mandate is to promote maximum employment and price stability. The FOMC provides further clarification on how it sets monetary policy. In setting monetary policy, the committee seeks to mitigate deviations of inflation from its longer-run goal and deviations of employment from the committee's assessment of its maximum level. These objectives are generally complementary. However, under circumstances in which the committee judges that the objectives are not complementary, it follows a balanced approach in promoting them, taking into account the magnitude of the deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with its mandate. Furthermore, a balanced approach and the 2015 statement will put equal weight on these two things, the inflation target and the natural unemployment rate of former Fed Chairman Bernanke, can be interpreted as an equal weight of stabilization of inflation and stabilization of unemployment. Indeed, former Fed Chair and current Treasury Secretary Yellen in 2012 stated, "The balanced approach strategy endorsed by the FOMC is consistent with the view that maximum employment and price stability stand on an equal footing as objectives of monetary policy." Furthermore, Fed Governor Garida in 2019 noted, "As a practical matter, our current strategy shares many elements with the policy framework known in the research literature as flexible inflation targeting. However, the Fed's mandate is much more explicit about the role of employment than that of most inflation-targeting central banks. And our statement reflects this by stating that when the two sides of the mandate are in conflict, neither one takes precedent over the other," as quoted in Lars Vensen's June 2019 article. The Fed has also indicated a strong understanding of where its mandate derives from and the need to re-examine how it applies monetary policy and do so transparently and invite views from outside itself. A speech in 2019 by Jerome H. Powell, chair of the Board of Governors of the Fed, illustrates this point well. Said Powell, "This year's symposium topic is challenges for monetary policy. And for the Federal Reserve, those challenges flow from our mandate to foster maximum employment and price stability. Thus, after a decade of progress toward maximum employment and price stability, the economy is close to both goals. Our challenge now is to do what monetary policy can do to sustain the expansion so that the benefits of the strong jobs market extend to more of those still left behind." He continues, "Finally, we have a responsibility to explain what we are doing and why we are doing it, so the American people and their elected representatives in Congress can provide oversight and hold us accountable. We are conducting a public review of our monetary policy strategy, tools and communications, the first of its kind for the Federal Reserve. We are evaluating the pros and cons of strategies that aim to reverse past misses of our inflation objective. We are examining the monetary policy tools we have used both in calm times and in crisis, and we are asking whether we should expand our toolkit. In addition, we are looking at how we might improve the communication of our policy framework. Public engagement, unprecedented in scope for the Fed, is at the heart of this effort. Through Fed Listens events, live-streamed on the internet, we are hearing a diverse range of perspectives, not only from academic experts, but also from representatives of consumer, labor, business, community, and other groups. Debates around the continued relevance of inflation targeting on its own, without reference to output stabilization, have been ongoing for a while. Indeed, the thinking occupies a whole range, including the possibility of a dual mandate of inflation targeting and output stabilization. In a paper in 2013, the IMF put it like this: "In this dual mandate framework, central banks' decisions would be based not only on their views about inflation, but also on direct measures of output and unemployment gaps. Central banks would thus have more discretion to allow inflation fluctuations if addressing them would exacerbate cyclical downturns." Central bank independence is about operational independence, not about goal or mandate independence, since these are not set by the central bank itself. Some central banks have their mandates and independence written into their country's constitution, while others are purely by an act of parliament. Regardless, though, the predominant wisdom is that you don't tinker with central bank mandates and their independence. Of course, those central banks whose mandates are written into their country's constitution are in a much stronger position, as no one may dare trifle with amendments to a country's constitution. Monetary policy is typically conducted using a benchmark rate as the instrument to target the inflation rate, variously raising the rate in inflationary times or reducing it to stimulate economic activity. The effect of a policy decision on interest rates has a more direct and immediate impact on economic activity, but also acts on the psyche of society and economic actors by signaling a tightening or relaxation of monetary policy. It's important to emphasize this latter point. In a theoretical sense, since the inflation rate is a lagging indicator, the central bank rate targets expected inflation and serves as a signal on inflationary expectations within society and economic actors. Inflationary expectations are key because they influence wage negotiations and other pricing decisions, thereby either keeping inflation stable or exacerbating it. The key role of the central bank in guiding the economic path of the economy cannot therefore be overemphasized. That is why the appointment of central bank governors is regarded as such an important decision by either the administration or parliament. It should also be obvious that central bank actions don't just affect inflation, but also the level of employment in an economy. Depending on societal sensibilities, a central bank's action or inaction on inflation or employment may play a significant role in the political fortunes of an administration or governing political party. This is the chief reason central banks are independent, to insulate them from political influence. There is some irony in this, though, because citizens do not observe the work of the central bank directly, and in many cases either don't understand it or perhaps even forget about its role and existence. In practice, therefore, even though it mostly can't directly do anything about it, citizens blame the administration or governing political party directly for high inflation and high unemployment. In fact, this is where US President Joe Biden finds himself now. His approval ratings are significantly very low, and one of the reasons given by respondents are his handling of inflation. In actual truth, the fault lies with the Fed, which took long to act in raising interest rates as inflation began to rise because the Fed governors thought, wrongly as it has turned out, that the inflation spike was temporary. The favored word at the time was transitory. Time will tell whether or not Biden will survive this. As for the Fed, the FOMC has begun an aggressive hiking of interest rates to try and tame inflation, even though on the other side there are worries of a recession occurring. The Fed is, however, not the only central bank that has embarked on a hiking trajectory. As there are inflation concerns in most world economies, so the central banks in most countries are raising interest rates, some more aggressively than others. Time will tell whether the world economy will be plunged into a recession or the hikes will tame inflation without too much socio-economic and potentially political pain.